Mag 7 stocks, including Apple, Amazon and Tesla, still holding strong. August 23, 2024. Here are 7 highlights. 1. Microsoft's AI-driven earnings show that doubling down on innovation is yielding results. 2. Alphabet, as Google's parent company, announced its first-ever dividend of 20 cents per share. 3. Amazon net income more than tripled to $10.4 billion. 4. Apple sales of its flagship iPhone fell 10% to $46 billion. 5. Tesla could reduce prices further as management aims to pass on most of the cost savings to customers to boost demand. 6. Meta exceeded analysts' expectations on both revenue and earnings for the first quarter. 7. Nvidia shares took a hit after investor Stanley Druckenmiller revealed that he had significantly reduced his large stake. Now let's dive in. The Magnificent Seven drove nearly 2/3 of the S&P 500's gains last year. But the question remains, can they replicate those exceptional returns this year? According to Bloomberg Intelligence data, profits for the Mag 7 inches are expected to surge 38% in the first quarter compared to a year ago, significantly outpacing the S&P 500's projected 2.4% year-over-year earnings growth. The Magnificent Seven were responsible for about 2/3 of the S&P 500's gains last year. But can they replicate those exceptional returns this year? According to Bloomberg Intelligence data, profits for the Mag 7 inches are projected to soar 38% in the first quarter compared to the previous year, far outpacing the overall S&P 500's expected 2.4% year-over-year earnings growth. This group of mega-cap tech companies, Alphabet, Google, Amazon, AMZN, Apple, AAPL, Meta Platforms, Meta, Microsoft, MSFT, Nvidia, NVDA, and Tesla, TSLA, are capitalizing on tech growth trends such as artificial intelligence, AI, and cloud computing. In 2023, the Magnificent Seven stocks jumped between 48% and 239%, contributing around 60% to the S&P 500's 24% total return for the year. Here's a look at how these megacaps performed in the first quarter and what to expect from Nvidia's upcoming report next week. Mag number 1. Microsoft. Microsoft's significant investment in AI seems to be paying off, as the world's largest public company reported $61.86 billion in revenue for the last quarter. On April 25, the company announced that its total revenue for the first 3 months of 2024, its fiscal third quarter, rose 17% to $61.86 billion, surpassing analysts' expectations of around $60.88 billion. Earnings per share also increased by 20% to $2.94, exceeding the anticipated $2.83. Microsoft's AI-driven earnings show that doubling down on innovation is yielding results, said Jeremy Goldman, Senior Director of Briefings at eMarketer, in an interview with Reuters. He highlighted the company's early investments in generative AI, including its substantial backing of OpenAI, the creator of ChatGPT. Sales in Microsoft's cloud division, the company's largest revenue generator, which includes its Azure computing platform, grew 21% during the quarter to $26.7 billion. This surpassed analysts' forecasts of $26.2 billion and exceeded the company's guidance. Microsoft continues to deliver strong third-quarter results, surpassing both our top and bottom line estimates, said Dan Romanoff, equity research analyst at Morningstar. The results are impressive from most angles, particularly in AI, Azure, and gaming. We also note a surge in bookings from large Azure deals and robust margin performance, despite pressures from the Activision acquisition. Mag number 2. Alphabet. Alphabet's first quarter revenue, reported on April 25, surged 15% as Google's parent company announced its first-ever dividend of 20 cents per share along with a $70 billion stock buyback. Google posted $80.5 billion in revenue for the first quarter of 2024 and reported earnings of $1.89 per share, up from $1.17, exceeding analysts' expectations on both fronts. The company also introduced its first dividend of 20 cents per share, with plans for quarterly payouts going forward. Our leadership in AI research and infrastructure, combined with our global product footprint, positions us well for the next wave of AI innovation, CEO Sundar Pichai stated in the earnings release. Alphabet is adopting a more stringent approach to costs compared to its AI rivals, continuing to reduce headcount and consolidate teams to mitigate the impact of infrastructure investments on profitability. Meanwhile, search advertising grew 14%, YouTube advertising surged 21%, and the cloud business showed impressive growth with a 28% revenue increase, the best result in over a year, noted Michael Hodel of Morningstar. Mag number 3. Amazon. Amazon reported better than expected earnings and revenue for the first quarter on April 30th, fueled by strong growth in advertising and cloud computing. The impressive results sent the retail giant's shares up by as much as 5% in pre-market trading. Amazon posted profits of $10.4 billion for the first 3 months of 2024, a significant jump from $3.2 billion during the same period last year. First quarter sales rose 13% to $143.3 billion. Driven by robust retail performance in North America and rapid expansion in Amazon Web Services, (OZ), the company's digital infrastructure division. Net income more than tripled to $10.4 billion. OZ sales accelerated by 17% in the first quarter, reaching $25 billion, surpassing Wall Street's forecast of 12% growth and $24.5 billion in sales. Looking ahead, Amazon expects revenue between $144 billion and $149 billion for the current quarter ending in June. CEO Andy Jassy highlighted the big opportunity Amazon sees in servicing AI customers, underscoring the company's focus on this rapidly growing sector. Amazon has been expanding its physical presence in Europe, recently committing €1.2 billion in France to create over 3,000 jobs and enhance its operations in the country. This move follows similar investments by other tech giants, such as Microsoft's €4 billion commitment to expanding its cloud and AI infrastructure in France, along with AI training and support for the local tech industry. Mamta Valecha, equity research analyst at Coulter Cheviot, remarked, "Amazon is a beloved brand, with expectations rising following strong performances from other cloud players like Microsoft and Google. Yet, we see a company delivering record profits and reinvesting those profits to fuel the next phase of growth." After an 81% surge in its stock price in 2023, Amazon is betting on generative AI to generate tens of billions in revenue for AWS in the coming years. Despite being slower to invest in this technology initially, Amazon is determined to become a dominant force in the market. Mag number 4. Apple. Apple reported fiscal second quarter earnings that exceeded estimates and announced an expanded stock buyback program. However, the company has been lagging in the AI race, while competitors like Microsoft, Amazon, and Meta have been pouring billions into AI infrastructure. Apple is only now beginning to make significant moves in this space. As reported on May 2nd, Apple is reportedly close to securing a deal with OpenAI to integrate ChatGPT into new AI features for the iPhone. This is notable as Microsoft, one of OpenAI's biggest backers, has already made significant strides in AI integration. Additionally, Apple is said to be in talks with Google and Anthropic, the creator of the Claude AI chatbot, to enhance capabilities like Siri and Search. The company is also reportedly developing its own AI chip for data centers, which are essential for powering AI-driven applications like chatbots. Apple reported revenue of $90.75 billion for the first 3 months of 2024, down 4% from the previous year but slightly ahead of consensus estimates of $90.3 billion. Sales of its flagship iPhone fell 10% to $46 billion, compared to $51.3 billion the previous year, while sales in China dropped to $16.3 billion for the quarter, down from $17.8 billion a year ago. Net income came in at $23.64 billion, or $1.53 per share, a slight decline from $24.16 billion, or $1.52 per share, in the same period last year. CEO Tim Cook sought to reassure investors about the company's position in China, the world's second-largest economy, noting that iPhone sales had actually increased in mainland China. "I maintain a great view of China in the long term," he said. The company also announced an additional $110 billion in share buybacks and increased its quarterly dividend by 4%. William Kerwin, an analyst at Morningstar, commented, "We project 6% compound annual revenue growth for Apple through fiscal 2028. The iPhone will remain the largest contributor to revenue during our forecast, with an expected 3% growth in iPhone revenue over the next 5 years, driven primarily by unit sales growth and modest price increases." Mag number 5. Tesla. On April 23, Tesla reported a 9% drop in first-quarter revenue, marking its largest decline since 2012 and falling short of analysts' expectations. The electric vehicle (EV) company attributed the decrease to the impact of ongoing price cuts. Tesla's profits for the first 3 months of the year were $1.13 billion, down significantly from $2.51 billion a year earlier. During the earnings call, CEO Elon Musk announced that the company plans to start production of new models in early 2025, if not late this year, adjusting the timeline from the previously anticipated second half of 2025. Seth Goldstein, an analyst at Morningstar, noted, "We slightly raised our 2024 deliveries forecast, compared to our previous expectation of no growth. This improved outlook is driven by Tesla's recent price cuts, though we also slightly lowered our near-term automotive gross margin forecast. We believe Tesla could reduce prices further as management aims to pass on most of the cost savings to customers to boost demand." Mag number 6. Meta Platforms. Meta exceeded analysts' expectations on both revenue and earnings for the first quarter, but a disappointing Q2 forecast left investors uneasy. On April 24, Meta reported a 27% increase in total revenue to $36.5 billion and earnings per share of $4.71, while also predicting a slight improvement for the current March-June quarter. However, Meta's outlook for second-quarter revenue, projected to be between $36.5 billion and $39 billion, fell short of the midpoint estimates of $38.24 billion, causing concern among investors. The company also raised its full-year capital expenditure guidance from $37 billion to $40 billion to continue accelerating our infrastructure investments to support our artificial intelligence (AI) roadmap, and indicated that capital expenditures are expected to continue increasing next year. Despite a strong performance, with Meta's stock climbing 131% over the past 12 months and more than 39% year-to-date, the company lost $132 billion in market cap following its earnings report. Several analysts have since lowered their target prices, making Meta the only Mag 7" stock that has struggled to impress the market. Mag number 7. NVIDIA, NVDA. The AI boom among tech megacaps wouldn't be possible without NVIDIA, whose chips have been crucial in powering this surge. Last year, NVIDIA's shares skyrocketed by 239%, driven by overwhelming demand for its graphics processing units. As demand continues to outpace supply, investors are eager to see if NVIDIA, the last of the Magnificent Seven to report, can sustain the AI-driven rally that has energized the market over the past year. NVIDIA is set to report on August 28, with earnings projected at $23.94 per share and revenue expected to reach $106.05 billion for the fiscal year, according to TradingView. Earlier this week, Nvidia shares took a hit after investor Stanley Druckenmiller revealed that he had significantly reduced his large stake in the chipmaker earlier this year, expressing concerns that the rapid AI boom might be overdone in the short term. Do you have any of these stocks? Do you believe they can keep being profitable on the long run? Let me know what you think in the comments below. Thanks for watching. Good luck and good profit, by Edward Cash Trader.